The Intelligent Investor by Benjamin Graham, often called the Bible of investing. This book is a must-read if you're serious about growing your wealth. Let's explore its timeless principles and how you can use them to make smarter investment decisions. Before we dive into the lessons, let's talk about the man behind the masterpiece. Benjamin Graham was a legendary economist and investor, widely regarded as the father of value investing. He taught at Columbia University and mentored Warren Buffett, who calls The Intelligent Investor the best book on investing ever written. Graham's insights are as relevant today as they were when he first wrote them.
Look back on a 38-year-old Warren Buffett, instead of an 88-year-old. If you were starting out today, would the principles that got you to where you've gotten still apply? In a world of so much technology, in a world of globalization, a lot of things have changed. Have they changed the fundamentals of investing?
Well, the principles, no, they haven't changed at all. I mean, you try to evaluate where a business is going to be in 5 or 10 or 20 years, and you try to buy it at the right price relative to that valuation, and you leave alone the ones you don't understand, and you do not try to guess the market. It's exactly what Ben Graham wrote in 1949, and no, the principles don't change at all.
So Ben Graham still applies?
Absolutely.
But what exactly made Graham so influential? He could break down complex financial concepts into practical strategies. His teachings helped investors weather market storms and focus on long-term success. Number 1. Introduction to Value Investing. Graham distinguishes between investing and speculation. Investing means analyzing a company's fundamentals and ensuring you're buying at a reasonable price. Speculation, on the other hand, is betting on short-term market movements, a risky game. Graham's advice? Always focus on the intrinsic value of an asset, not the noise of the market. To put it simply, investing is about being patient and disciplined, while speculation is more like gambling. Ask yourself, are you an investor or a speculator? Number 2, Mr. Market Analogy. Imagine you have a business partner named Mr. Market who offers to buy or sell stocks daily. Some days he's overly optimistic and other days he's extremely pessimistic. Graham's advice? Don't let Mr. Market's mood swings influence your decisions. Use his irrationality to your advantage by buying when prices are low and selling when they're high. This analogy teaches us to stay calm and rational. Remember, markets can be unpredictable, but your strategy doesn't have to be. Number 3, margin of safety. The margin of safety is a cornerstone of value investing. It means buying stocks at a price significantly below their intrinsic value, creating a cushion against potential losses. Think of it like driving with extra space between you and the car ahead. It's all about reducing risk. The margin of safety isn't just a number, it's a mindset. It's about being conservative and prioritizing protection over potential profits. Number 4, defensive versus enterprising. Investor. Graham categorizes investors into 2 types, defensive and enterprising. Defensive investors prioritize safety and stable returns, focusing on diversified portfolios of blue-chip stocks or index funds. Enterprising investors actively seek undervalued stocks and are willing to put in the extra effort. Decide which approach suits your temperament and stick to it. Defensive investors often have other priorities like a full-time job and prefer a hands-off approach. On the other hand, enterprising investors are willing to dedicate time and energy to researching opportunities. Which one are you? Number 5. Key lessons on risk and returns. One of Graham's most important lessons is understanding that risk and return are not directly proportional. Higher risk doesn't always mean higher returns. Instead, focus on minimizing risks by diversifying and investing with a margin of safety. Patience and discipline are your best tools. Remember, it's not about avoiding risk altogether. It's about managing it wisely. Number 6, stock selection and portfolio management. For stock selection, Graham recommends looking at companies with strong financials, low debt, and a history of stable earnings. Defensive investors should focus on established companies in diverse industries, while enterprising investors can target smaller, undervalued companies. Diversification is key to managing risk. When building your portfolio, think of it like assembling a team. Each stock should play a role in balancing risk and return. Even in today's fast-paced markets, Graham's principles hold true. The emphasis on discipline, patience, and rational decision-making is more important than ever. Whether you're a beginner or a seasoned investor, these lessons provide a solid foundation for building wealth. Think about it. Even with technology and algorithms, human behavior hasn't changed. Fear and greed still dominate markets, and that's why Graham's advice is timeless. Thanks for joining me today. The Intelligent Investor is more than just a book. It's a guide to thinking wisely about money and risk. If you found this video helpful, please give it a thumbs up, share it with friends, and subscribe for more content like this. Let me know in the comments, what's your favorite investing lesson? Until next time, happy investing.